Good morning, everybody. It is Friday, it's the 9th, and this is today's agenda. Markets brace for today's many risk events. President Trump wants cheaper mortgages, plus mega mining M&A.
Modestly risk on when it comes to the equity markets, then the MSCI Asia Pacific in that region gains of 0.1%. European futures, a slightly brighter picture here. We'll see how and to what extent that holds, pointing up by 0.4% after the losses of yesterday, down about 0.2 on the S&P, on the Stock 600, of course, having broken through that record on Tuesday. S&P futures then currently flat as we lead up to the data. Arguably, investors looking for more clarity before they put those trades on. The countdown to the opening trade starts right now.
Friday morning. Good morning. Big day for the bond market. Huge day for the bond market. If you are in London, your lunchtime menu is basically payrolls and the reaction to what is happening with the labour market in the United States. If you're in London, your dinner menu is basically made up of the Supreme Court and the ruling on tariffs. You can't go home, basically. The afternoon is going to be packed with events out of the United States. What's weird about this is coming into it, the Treasury market is in a super tight range, 10 bips over the last month, and the move index is super low. So do we have the potential for volatility?
Yeah, we probably do, don't we? Especially because some of these events are not going to be necessarily, well, we don't know if they're happening, firstly, the Supreme Court, for example. If it does happen, if we do get a ruling, will it be very easy to understand? Will it be very evident what it all means straight away in a format that the markets can understand? That's one of the things I'm wrestling with this morning. Will the decisions on the various tariffs be the same? What will President Trump's response be? Will the Supreme Court actually delve into what happens as a result of this in terms of refunds?
What will the remedies be if they rule against the Trump administration as they potentially, arguably, look to avoid massive economic disruption? You talked about the fact that the 10 years been trading in that range. In terms of the non-farm payrolls, just to update viewers, the survey number for December, 70,000 versus 64,000 in the previous month. Again, we expect to get this to be a cleaner print. The unemployment level expected to edge a little lower from 4.6% to 4.5%. So
that's significant because if it goes higher, you trigger the SARM rule, which everybody's getting quite concerned about. Is 70,000 enough? 70,000 feels enough right now, doesn't it? This is an economy that basically is beginning maybe to gather a little bit of momentum, and you take out the immigration story, 70,000 sounds like an OK number.
To your point about the SARM rule, Bloomberg Economics putting the focus for that reason on that unemployment rate rather than the number of jobs created, and suggesting that the supply of labour story is evolving a little bit. And it is cleaner, isn't it? Is it fully clean, this number? I mean, mostly it's clean, but there does seem to be...
The payroll number is the most ridiculous number in the world. So it's never clean and it's never understandable, and the market reaction to it is never
but still
kind of what you think. But we obsess with it. Well, Valerie does. She'll be here soon.
Housing, though, makes a lot of sense, doesn't it? I mean, is this a Trump administration increasingly looking like China to me? The kind of the interventions coming through.
You have experience having lived there.
Having lived there. And this time, intervening in the housing market with the pressure on Freddie Mae and Freddie Mac, which, of course, the Trump administration has the rights to do that because it's in a conservatorship.
Yeah.
Which was a similar legal structure to Britney Spears, by the way. But anyway, the mortgage market, 200 billion mortgage-backed securities. Guy.
Tom, maybe giving a clue away as to his music tastes.
Yeah, I think so.
I think
so,
inadvertently. I see him as a Britney Spears fan.
Well, we have seen President Trump's decision here, so ordering Fannie Mae and Freddie Mac to buy more MBS. The aim here, the same as yesterday's story, to bring down the cost of home ownership, to bring down, in this case, the mortgage cost. It's all about affordability. We're going to see much more of this then, one assumes, ahead of the midterms. We were talking yesterday about defence and oil. Yeah. Other things in the housing market, I mean, that's just this week, the parts of the market that this administration has been micromanaging.
Yeah, it basically wants to... It needs the affordability story to get better. But the question is, from a market point of view, to your point about China, how do you deal with this? This has to be a negative from a market point of view.
It's a slow burn negative, that as they build and build and build, we start to realise that markets are less free than we thought they were. We can't rely on the reaction functions.
Well, you can't rely on the mechanisms which we've normally relied on. Things are getting whipsawed all over the place at the moment. It was housing stocks, it's what's happening with mortgages, it's what's happening in the oil market. Trump's desire to intervene in so many aspects of market function has to have an impact, and it has, in theory, it has to be negative.
Well, I was going to say, you finish this conversation. I was going to take some to my next
just before we move on to the next one, is that the two key themes that we've got this week then is the policy aligning to November and the midterms, and that's going to be a key theme for 2026, and then the risks around intervention linked to that into various different sectors and how investors adjust to that and try and hedge for that or even position for that. And then there's the mining story, separate to what's happening, of course, with Trump administration, but potentially another mega deal with Rio and Glencore.
Well, you say separate, but actually part of the reason we've seen copper prices so high in certain parts of the world and so tight the supply in other parts is because of uncertainty around tariffs. And so maybe there are opportunities in this for certain businesses, depending where you're operating, but we've got more conversations, Tom, going on around M&A.
And so this is about copper, to your point, because it's the assets, both companies, Rio and Glencore, having significant copper assets. We've seen the prices above 13,000, not today, a little softer. It's up today, copper prices, but below that 13,000 level. What they do with coal at Glencore remains a question. And for Rio as well, the iron ore assets looking a little less valuable given the continued real estate squeeze in China, potentially the largest deal in the money space on record.
Let's back up the very large truck for a moment and just think about where we were. We've tried this deal before.
Yeah.
Culturally, it's a difficult fit. I think
Twice before, at least.
Yeah, and precisely. The coal assets are a problem. You put Glencore and Rio Tinto together, and kind of clearly copper is the narrative here, but there's nickel and other things thrown in as well. But there are cultural issues. There's the issue of coal. I suspect the Chinese are going to have something to say about it. So there's a regulatory aspect to all of this. How easy is this going to be to get over the line? The market is reacting this morning, sending Glencore up sharply and Rio down sharply. The market clearly believes there is something here. But it's going to be hard to get this done because these are the assets that governments around the world are increasingly nervous about.
Yes, absolutely, because of the role that they play in everything, in defence, in electrification and all sorts. We will no doubt return to the mining story. We will throughout the programme. Let's tell you what's coming up on the programme in terms of the guest conversations we're going to be having. We'll talk to UBS's Global Wealth Management EMEA CIO. So a perfect voice to get a perspective on some of these stories we've been throwing around today. Where are the risks in today's session and looking further into 2026? We'll also be talking about the Supreme Court ruling. Is that the big risk event of the day? How is that going to play out? What do markets need to know to watch for? Ilaria De Joya will be with us, Birmingham City University law professor. Max Kettner also with us, chief multi-asset strategist at HSBC. So another voice to digest all of the fast-moving news events that we have at the start of this year.
Yeah, and a programming note as well this Friday, because today opening trade is going to end half an hour earlier than normal, and we're going to be followed by Bloomberg Tech Europe, which takes a deep dive into how AI is shaking up the music industry. In this episode, we're going to hear from my exclusive sit down with Grammy-winning artist Will.i.am, who is all in on artificial intelligence.
It's a renaissance. The same way the Renaissance, catapulted, dimensionalized the creative industry in the past. The Renaissance, this new Renaissance, to do it for this era that we're in. So it's the age of the hyper creative.
So you can get more of that conversation 8:30 a.m. UK time. You can also watch on the terminal and, of course, on YouTube as well.
Yes, and really interesting the way that some creatives are really pushing back against AI, others embracing. Yep. I'm sure there's a whole host of grades in between. Let's tell you what is coming up from a markets perspective today then. We do have data that is not non-farm payrolls, but obviously that is the headline event in terms of the data points that we're watching for. 10 a.m. UK time, then Euro area retail sales as well. 3 o'clock, the Supreme Court gives its opinions. 3 o'clock UK time, this is. We get opinions from the Supreme Court. We think that's going to be about tariffs. There's no guarantee, but we think it is. And, of course, President Trump will be meeting later with oil bosses, which, this is another risk event for the day. The messaging in this meeting, according to our reporting, seems to be do it for your country, invest in Venezuela for your country. That's where we are in the oil conversation.
Again, this is intervention, more intervention. The word intervention seems to be cropping up time and time again. Do it for your country. It almost feels like a wartime footing, doesn't it, in terms of kind of the way that Trump is portraying some of this. And he's pushing these guys very strongly. How do shareholders feel about it? Is it going to be good for shareholders? Do we actually need more oil? I had lots of questions surrounding this, and it feels like the wildcatters at one end are all in, but maybe the bigger oil companies with shareholders tapping them on the shoulder a little bit more cautious maybe.
At a time when Goldman Sachs says that its clients are the most bearish on oil in 10 years. So again, weak oil prices and the cost of that infrastructure build-out in Venezuela. Are there sweeteners for these companies if they do sign up?
This week? Gone up.
Yes, it has, hasn't it? And some of that is the geopolitics, not the things we've been talking about necessarily, but Iran and concern around Russia.
Yeah.
So those things, they're certainly on watch still.
Iran's a big story in this, so let's talk a little bit about that. What else do you need to know this Friday morning? Anti-government protests in Iran have escalated significantly overnight, with the regime in Tehran responding with a nationwide internet blackout. Thousands of people appear to have taken to the streets across the country, including the capital, Tehran. The unrest is emerging as the most serious threat to Iran's supreme leader since a 2022 nationwide uprising. Meanwhile, in a Fox News interview, the US President, Donald Trump, issued this warning.
Iran on notice that if they start shooting at them, these people are totally unarmed people. And they love their country. They want something to happen. Look at their country. They've gone back 150 years. But I've told them that if they do anything bad to these people, we're going to hit them very hard.
In the United States, the FBI has taken over the investigation into a fatal shooting in Minneapolis of a U.S. citizen by immigration officials. Minnesota state law enforcement has withdrawn from the investigation after claiming that it has been denied access to evidence. More large-scale street protests are expected over the weekend. And moving to technology, TSMC's December sales topped estimates, rising by nearly 20%. The Taiwanese giant, which is NVIDIA's go-to chip maker, will report full quarterly earnings next week, along with a forecast on capital spending for 2026. TSMC has received multiple upgrades recently on expectations of strong revenue growth and improving profitability, amid growing predictions of higher AI spending this year. Tom?
It's not just the data centres. I mean, data centres is important in terms of the components that TSMC produces that goes into those, but they've also benefited, it's worth noting as well, I think, that iPhone 17 sales have actually been stronger than many had expected. And so TSMC, the major producer, of course, in terms of manufacturing those iPhones, getting a lift from that as well. Yeah. So it's those two things that seem to be giving that momentum to TSMC. But it's a reminder that there are still no real significant evidence in terms of the manufacturers and the designers of these chips that the bubble is slowing, that demand is weakening. We have not seen that yet.
As the bubble gets bigger, does the risk grow around Taiwan? Presumably it has to. All of the stuff that comes out of Taiwan into the data centres, the geopolitics overlapping.
Do the stakes change and evolve around Taiwan, perhaps?
And well, that reminds us, President Trump meeting with the Intel CEO yesterday, and of course that 10% stake, there's a reason for that, national security. So the Trump administration is cognizant, clearly, of that risk and wanting to reshore, and Intel is going to play that role there.
Coming up on the programme, we will check on mining stocks. Of course, today's news, potential for M&A, consolidation within that sector. We'll get to that. Plus, BMW and Porsche are downgraded. Barclays, as GM takes a hit from cratering EV demand. We'll be across those moves in the auto sector at the open. Up next, it's Jobs Day. And markets are waiting for the numbers, but is it today's main risk event? There are other contenders, of course. If you have questions, if you want to get involved in these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is on a weakening path and inflation is an underlying inflation's already running close to our target and on trajectory to hit the target. There's just not a real reason to be so restrictive, and we're running unnecessary risks on the labor market by being so restrictive.
Fed Governor Stephen Miron there, of course, speaking to Bloomberg. He also said he's looking for 150 basis points of interest rate cuts this year. That's more than many, of course. As he pointed out, he sees rates as being very restrictive. Let's bring in Bloomberg's Valerie Teitel for more. Val, good morning. So, of course, the focus there from Myron on inflation and on unemployment, and we get details around unemployment and jobs today. What are you watching for?
Look, I think the big risk for the market is that we get an unexpected drop in the unemployment rate. And off the back of that, we really start to doubt whether the labor market is going to continue to weaken into 2026. That could be the thing that could cause a major upheaval in front-end pricing. Maybe we could start to see even more cuts priced out of the front end. We're currently entertaining 2 cuts from the Federal Reserve. Their dot plot had around 1 cut from the Fed into the end of the year. So that's where the debate is now. Now, we are expected to see a drop in the unemployment rate today from 4.6% to 4.5%. But if we go into 4.4 territory, I think we could really see a narrative change in the market.
Val, what's the biggest risk, so from the non-farms to the tariff story and the Supreme Court ruling that could come through today, what is the biggest risk there when it comes to the market?
So, oddly, I think the biggest risk today is if the Supreme Court actually upholds Trump tariffs. If we look at how the betting market has priced in this ruling, it's showing around a 1 in 4 chance that the Supreme Court does rule in favor of Trump tariffs. So you could take that as the market is already pricing in the fact that IEEPA will be smacked down. Now, there's still a lot of questions about the ruling today, one of which is this going to be a clear decision? Because essentially the Supreme Court could just narrow the use of IEEPA and in some way cause a bit more confusion off the back of that. They could also push some of the decision-making back down to lower courts. That could be the decision on what to do about repaying the tariff revenue. If that's pushed down to lower courts, again, that just causes, the uncertainty to last a lot longer. The other curveball is we don't know how quickly Trump is going to react off the back of this. The administration has said that they are ready to implement placeholder tariffs in lieu of these IEEPA tariffs. But again, obviously Trump wants to act as soon as possible because he doesn't want to create what happened in the first quarter of last year. We had all of these importers trying to race ahead of Trump tariffs. Remember, that saw a big drop in GDP. And ahead of the midterms, I doubt Trump is going to want a negative GDP print if we do see this kind of racing ahead in this tariff holiday.
More excited about tariffs than payrolls?
No, I think so. I think there's going to be a lot of nuance today, and I think the market reaction is likely to be very impulsive, whether that ends up being the right call or not. But again, have an eye on the Treasury market. It does seem to be that every time that we get worried about Trump having to pay back this tariff revenue, we have the back end steepening, and we get this kind of fiscal sustainability worry again.
Big day for the bond market. Big day for Valerie's Hotel. Very excited. Temis Klios is the head of the EMEA Investment Office at UBS Global Wealth Management. He also joins us around the table this morning. The bond market's been really stable.
Absolutely.
Over the last month or so. Been a really tight range. Do you think by the end of today rates are going to be higher or lower?
Actually, if I were to guess, I would say there won't be a big move unless what Valerie said, if there's a big discrepancy between expectations and what the actual print is. If we have very low unemployment number or very high unemployment number, that could cause a movement in the Treasury market. If we have 60, 70, 80,000 jobs, I think the market is going to...
Do you think we stay in the range?
I mean, the payroll number is so volatile, right? And if you look at the December number, or is basically you have seasonality in there, you have cold weather payback. So there's a number of factors that are driving that payroll number. So it could be a noisy number. And then I think if we go one step forward, let's say the unemployment number is either too high or too low. The market starts to start thinking, what's the next step? Next step is the announcement of the chairman of the Fed, right? And what does that mean for cuts? And what is the composition of the Fed? What happens with the Lisa Cook case? So it's a lot of other narratives.
Quickly.
So I think the market will move very quickly from there. But on the back of it, if it's a number that is very high, the market will start thinking maybe less cuts. But already it's only 2 cuts priced in. So I don't know that the market is going to start thinking, well, there will be no cuts, given what else is going on with the Fed. Now, if the number is weak, then the market is going to start thinking, well, the economy is weak. Right? Maybe we get a lot more cuts. So I think it's a bit asymmetric. It's more likely that by the end of the day, the markets start thinking, if the number is very weak, that maybe we get more cuts rather than the other way around.
So, Temis, you put the focus firmly on payrolls, because Sky was asking about where the 10-year goes, and you have not mentioned at all the Supreme Court. And, is that intentional? Is that because you just don't think it's going to have that much bearing? Because it could be brought into the mix because of the implications for refunds and the fiscal story.
And it's very difficult to predict the outcome as well, right? So if we take the 2 possible outcomes, either the Supreme Court says, OK, that's legal, so the tariffs stay, that would be a surprise. But how does the market react? Does the market rally or retreats on the back of it? Because if you have the other side of the equation, if the Supreme Court says, well, it's illegal, then basically it's got to take a bit of time to reimpose tariffs. They've got to be more narrow. ahead of the midterm elections, maybe the administration decides to have a bit less rather than more tariffs. So you have basically less pressure on inflation from tariffs, but more pressure because basically you start spending more, right? You get the reimbursement, there's more money in the consumer's hands. So basically, net, where does that play out? So I'm not sure that sort of is going to be as big a catalyst.
OK, could create volatility, but we'll see.
Yeah.
We are in a very political economy. It's been true of many parts of the world for a very long time, but increasingly so in the United States, it seems, Themis. Is this something that is increasingly factoring into your thinking? The fact that the level of intervention we see from the political side?
What we try and do is look through to what does it actually mean.
Yes,
so
where it changes policy.
Well, or how does that impact the economy and the bond market and the equity market? So if we have more intervention from the administration, the government, does that mean more borrowing from the U.S. government? If it's more borrowing, what does it mean for treasuries, long duration treasuries, right? And that is something that we keep thinking about because that is important and will have an impact on the bond market, potentially also the equity market.
Themis, just pushing on that point, does this increasingly interventionist US administration across different sectors put a cap potentially on equity gains? How, as an investor, how much of a risk is that to how you think about positioning?
It potentially is one negative element in the thinking because it's a level of unpredictability. But if we think about the way the administration has been intervening, it's often to stimulate or protect the industry. So there is a positive element to it as well. So there is clearly, if you go on a narrow level of a sector base like the defense, you cannot do buybacks, right? That's a negative. But at the same time, the administration is saying, we're going to help you, right? So the sector rallies. So it's always, there is a level of unpredictability, but the government has actually been trying to support the industry.
On the rotation that we've seen between the large caps, the S&P 500 and the Russell 2000, more pronounced actually is the NASDAQ and the Russell 2000 since the start of this year. Does that continue, do you think? And how much of that is dependent on the rate cut scenario continuing to unfold as markets are predicting further 2 cuts?
It's not totally surprising given the narrowness of the market during 2025. Actually, the last 3 years, a lot of the rally came from the tech stocks. Some rotation makes sense, especially if you're thinking there's more fiscal spending, more cyclical recovery, then you expect the rest of the market to broaden out.
That rotation has further to go.
So, yes, it has more to go, but still, I would say that technology is still where you've got to get the highest growth in earnings. So, yes, you have broadening of the market, but I think we're going to see more sort of synchronous improvement in the market rather than one small part of the market basically doing all the work.
What do you think is driving markets right now? Portfolio manager sitting out there right now, what do you think is moving their decision-making?
Well, the way we would look at it is ultimately what's happening to the economy, because ultimately that's what drives
so what is happening to the
earnings.
Economy?
Well, the economy is surprising on the upside. It's actually surprising on the upside across all regions. Europe, US, China. So
rate hikes, not rate cuts?
Rate hikes, if you believe that's going to happen, given what we're talking about the Fed, then it's going to possibly be a headwind for the economy.
Okay.
But again, why is there's going to be a sort of a negative? Because the economy is stronger. Is that a negative?
Themis, nice to see you. Themis Kleos, head of EMEA Investment Office at UBS Global Wealth Management. Supreme Court next. This is Bloomberg. How you doing? Friday morning. There's a lot about to happen, as a result of which, to be honest, US futures, equity futures are doing virtually nothing at the moment. European futures are a bit more positive. There's a mining story that we need to fold in. There's a few other things that we need to catch up on from the United States yesterday. But the sense seems to be there is a big day ahead. Sit on your hands. Maybe wait for lunchtime.
Let's check in on the bond markets then as well. There's not a lot to tell you about here, but there could be some volatility, of course, depending on what happens with non-farm payrolls, the Supreme Court ruling, how that affects treasuries and the read across then to European sovereign. But for now, you're seeing marginal selling pressure coming through. The German Bund 10-year currently at 287, just a move higher, 1 basis point, largely unchanged on CAC current on the French OATs, I should say, and the Italian BTPs at 351, also largely unchanged. We watch gilts, of course, at 8 a.m. UK time, but not a huge amount of movement across the sovereign debt space. That could change later today, of course.
Now, let's talk about one of the big risk events of the day, which is the fact that the US Supreme Court gets its first chance to rule on the legality of US President Donald Trump's sweeping tariffs later today. Lower courts had previously ruled that the levies issued last year were illegal, but import taxes remained in place to allow the Trump administration to make its case before the Supreme Court. That has now happened, and now we are expecting that possibly, we get the result of their deliberations today. Let's bring in Ilaria De Gioia, who is a law professor at Birmingham City University and can help us understand what's at stake here. Ilaria, very good to have you with us. Thank you for joining us. So the expectation seems to be, not from everybody, that we get some sort of decision today. That's not certain, but that is an expectation. And that the tariffs are struck down. And we're talking about IEEPA and fentanyl tariffs here. But what is the nuance that we need to be aware of, Ilaria, in terms of what could go around that decision? Because it might not be backward-looking, it might not include what happens next, there might be abstentions. Tell us about some of the nuance to watch for.
Yes, of course. First of all, let's start with what you said. It is just possible that we will have a decision today. The reason why we think that we may have a decision is because the Supreme Court did what we call an expedited process. So we expect that the expedited process will end today and we will have a decision. Now, the decision is expected, at least from my point of view, to be a narrow statutory ruling. What does this mean? Sometimes the Supreme Court can decide on big constitutional issues and give broader decisions that affect also future interpretations of the Constitution. Sometimes it gives very narrow decisions that affect only a particular case or a particular statute. Now, because this is an expedited decision, meaning justices didn't have much time to make a decision, this may be the case. What does it mean then? It means that they may strike down tariffs on the basis that the statute doesn't cover the power of the president to issue tariffs, but also we need to look at the nuances, as you said, at the different options. One of the options is that they would avoid all the problems related to the reimbursement of these tariffs to companies and this big a mess, as the justices defined it during the ruling, and they can decide that the decisions only applies from this day onwards, so it doesn't affect refunds. Of course, you understand that this will create a lot of legal challenges. On the other hand, if they strike down tariffs fully, then that creates legal challenges from the administration point of view. So whatever happens, it will not be the end. It will lead to many, many other legal battles.
It will not be the end, Ilaria, yes. And so we could see the Trump administration responding. Well, they will no doubt respond to whatever the decision is here. And if the tariffs are struck down, making efforts to try and replace those tariffs with Section 301, Section 232 tariffs instead. How long would the process be to try and get us to that point? What's the window of uncertainty?
Well, there is a reason why President Trump didn't use those provisions before, and that is because they are lengthy process. They are processes that require authorizations from various other administration authorities. So it will take a good, possibly half a year or a year to get to that point. It will take time. It can also happen that Trump convinces Congress to pass laws that back the authority, the tariff imposing authority for president. It can be that Congress passes tariffs themselves. But again, this takes a long time. There is a reason, as I said, why Trump didn't use those powers before. So lots to be watched, lots of problematic legal issue coming if the tariffs are struck down.
Ilaria, what do you think I'm going to have? Do you think I'm going to be more confused or less confused by the end of the day if we get the ruling?
The answer is that probably we will be more confused, and not only we will be more confused, the administration will be confused. Of course, they put forward mechanisms already for reimbursement. For example, the administration has already created an online platform for companies to get tax reimbursement, and that asked companies to log in on the portal to sign up by the 6th of February in order to get up to speed with the online process. So the administration is preparing somehow to handle the situation. But of course, it's a big amount of money. We're talking about hundreds of billions dollars and lots of companies. So it will be very confusing for everyone.
If I'm in Brussels, London, Beijing, what do you think this is going to mean for me?
From a European point of view, of course, this means European companies lost in translation in what they have to do. Do they have to apply for refunds on the US website? How does this work for the European companies? This is still, we just don't know. We just have to wait and see what instructions will be laid for us.
OK, so that's how some of the different jurisdictions might be thinking about it, Ilaria. What about the companies? There's, I think, more than 1,000 companies signed up on the other side of this legal case versus the Trump administration. Just to be clear, you don't think they're going to be getting refunds anytime soon, or is there now a platform in place to issue refunds to those companies dependent on the ruling?
The online platform is for tax refunds, OK? It has not been created on purpose for this particular refund. It's a general reform of the administration getting ready to refund taxes. But it may be one of the tools used to issue these particular refunds.
OK. And on the sectoral tariffs and on the reciprocal tariffs, those are not being included in this Supreme Court case. Are those clear and they are undisputed at this point in terms of the levers that this Trump administration can continue to pull?
Yes, because those sectoral tariffs, like tariffs on steel, for example, are covered by a different statutory authorities. They're not within the IEEPA, so those will still stay, and those are actually very much easier to implement than the type of individual tariffs implemented under IEEPA.
OK, Ilaria, thank you very much. Really important context as we lead up potentially to that decision later today from the Supreme Court. Ilaria Di Gioia, law professor at Birmingham City University. Meanwhile, White House trade advisor Peter Navarro spoke to Michelle Hussein ahead of the Supreme Court ruling. Someone, of course, has been consequential in crafting those tariffs. He's been speaking to Michelle. Take a listen.
I'm very confident that we have a very, very good chance. I mean, the law is on our side. The law is on our side here. So let's win that. Now, if we don't win, there's the whole alphabet number soup of things we've got.
Would you consider resigning if the case is lost?
Oh, of course not. That's silly.
Navarro also doubled down on tariffs, adding that other countries should follow America's lead.
We are strongly encouraging Europe to adopt exactly the same level of tariffs that we adopt, for the simple reason that when the president puts up tariffs to defend America from Chinese cheating, China can't sell as much here. Where does it sell it? Dumps it in Europe, dumps it in Mexico.
You can listen to the full conversation between Michelle Hussein and Peter Navarro. Just search The Michelle Hussein Show wherever you get your podcasts. And European policymakers clearly are aware and sensitive to the issue of dumping, and that has historically been a challenge that China has posed, but particularly when it comes to the auto sector. Some tariffs are in place, some are still being debated. The Germans and the French have different views on this.
Are we going to see deflation in Europe as a result of the Chinese dumping their products into Europe because they can't take it to the United States? You saw the trade numbers out of the United States. There's already evidence of that happening.
Yeah, I mean, President Macron has talked about it already, about being alert to it, so Europe very aware. Just on the Supreme Court, I am wondering, and listening to Ilaria there speaking about it, I wonder if they tell us anything really about how the refund process works. Lots of companies want their money back, but we often talk about this as a tax on consumers. I wonder where the consumer groups are going to start lining up to try and get that money, you know, another step along that chain back into the hands of consumers, and whether President Trump might prefer something like that because he's wanted to find ways to give money back. Yes, hasn't he? And I wonder how,
how does the front end of the front bond market recover from this? Like, T-bills issuance is going to be a huge story. They have to fund that.
Will they also be confused by today?
I think everybody's just going to be really confused. But the historical precedent here is really interesting. You look back to the 1930s, you look at the alphabet agencies, FDR, his first wave of the New Deal was completely thrown out by the Supreme Court, and the tension between the White House House and the Supreme Court really ramped up at that point. So I'm just wondering how the relationship could change here between those two institutions if it rules against.
Given that the Supreme Court is stacked in the Republicans' favour, and if they rule against, when this is a Supreme Court that has, in recent history, been quite favourable to the Republican side and the Trump administration, how that changes that dynamic for other cases as well.
Talking about tensions with the executive.
We're going to do more of that next. Coming up, waiting for a new chair.
We're still 4 candidates. It's the president's decision.
Time frame still the same?
I would expect president's going to Davos, I think, in 2 weeks. So I don't know whether it'll be right before or right after that, but I think in January.
More on the Fed next. This is Bloomberg. Five minutes past the hour, 15 minutes to go until the opening trade here in Europe. Equity markets broadly buoyant at this point, but US futures are basically at a standstill, waiting for the big risk events of the day. We've already talked about 2 of them, to be honest. What is happening with the payroll number, lunchtime, what is happening in the Supreme Court if you get the IEPA ruling. That's going to happen a little later on the day. There are other risk events out there as well. One of them relates to what is happening in the oil market. The US President Donald Trump set to convene a meeting with nearly 20 oil executives. It's happening at the White House, we think. Sources say representatives from Repsol, Exxon, Chevron are all going to be there. Harold Hamm's going to be there as well. Basically, they're there to discuss reviving Venezuela's oil output after President Nicolas Maduro was deposed. So Bloomberg Originals basically has done this. We're looking at how Chevron, which has been there the whole time, has managed to maintain its presence in Venezuela. Take a look.
The United States has carried out a series of strikes against Venezuela, announcing the capture of Nicolas Maduro and his wife.
Nicolas Maduro stood in federal court and pleaded not guilty to narco-terrorism charges.
Donald Trump said his military buildup in the Caribbean and destruction of civilian boats there was about alleged drug trafficking. But following the U.S. attack on Venezuela, another reason has taken center stage.
The oil business in Venezuela has been a bust, a total bust, for a long period of time.
Everything that we've seen during his second administration has been consistent with his view that the U.S. energy dominance is key to his agenda.
We're going to have our very large United States oil companies go in, spend billions of dollars, fix the badly broken infrastructure, and start making money for the country.
But one U.S. oil company is already there and has been for decades.
Chevron produces about 25% of Venezuela's oil today, is the largest investor in the oil industry and in the country.
We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela.
This is a story about the extent to which a US oil company is willing to go through the trials and tribulations of geopolitics in order to stay in a country that has the world's biggest oil reserves.
Chevron has virtually no competition. It has no oversight. And so it's really a very unique situation.
So how did Chevron manage to stay in Venezuela when everyone else left? And what role could it play in the country's future if Trump gets his way?
So that was a little taster. You want to watch the full thing? Subscribers can do so on the Bloomberg terminal or online, Bloomberg.com. One of the risk events on today's agenda.
Yeah, absolutely. That meeting then at the White House with oil executives taking place later on today, but we have other risk events to focus in on. Let's talk about them. Bloomberg Markets Live, Skylar Montgomery-Koning joins us around the desk right now for 3 minutes on the markets. And Skylar, we've only got 3 minutes to talk about all of the risk events that are facing markets today. There's the oil meeting a lot later on today, but before that, we are likely to get the Supreme Court giving its verdict on tariffs, and we are going to get payrolls. What's your focus going to be on?
I think maybe we start with non-farm payrolls because that's very much the big one. And part of it is the context of where we're coming from. So data so far this week, I think, if anything, has leaned on the strong side. But it's been kind of all over the place, right? So JOLTS data, the headline number was quite weak, but the mix between quits and layoffs was strong. You had ISM manufacturing weak, but services strong. And so the market's really looking for direction from the payroll number today, especially given that the March meeting for the Fed is priced at something like 11 basis points. So that kind of, is that going to get pushed out? Is it going to be kind of firmed up in terms of that cut pricing? And I think certainly if we get an inline print, consensus expects a relatively positive outcome. So unemployment rate ticking down, that can kind of give the go-ahead for the equity market to rally because it tells you that the labor market is still strong, but the direction of easing is still firm despite that.
Scarlett, how are we thinking about the Supreme Court, the potential Supreme Court ruling on tariffs and how that affects Treasuries? I mean, how much is priced in, essentially, in terms of a potential narrow ruling, if that's what comes through? What is priced in at this point? How much vulnerability is there on that?
I think there is a fair amount of vulnerability in the short term. So the risk here is that they're ruled illegal and you have to do repayments of the money that's been collected so far. Now, I think the Treasury market in particular has been comforted by the idea that your increased spending that's happening this year is being offset somewhat by tariff revenue being collected. So if we don't have that anymore, then certainly I think risk premium would rise because you get more worried about the deficit. I do think it's more of a short-term reaction than a long-term because there's a recognition that you have other ways to impose tariffs. You know, Trump is very, very happy with what's happened from a tariff perspective in terms of they're no longer seen as just a U.S. growth negative, and they are collecting significant revenues. So I think you do some kind of other tariff collection. That means that there's not a sustained impact. The growth impact is a little bit more difficult to interpret in terms of short term. It could be seen as positive for U.S. growth, which, you know, that means there's conflicting signals for the dollar in terms of U.S. growth positive, dollar positive, yields negative, premium in terms of that's more negative for the dollar. But again, if tariffs are just reinstated in a different form, it just means that maybe you're looking at sectors rather than countries.
US 10-year, 411, 420. Where am I going? Up or down?
I mean, this is the problem is we've just been range trading, right?
Yeah,
so for the
in
front
a really
end,
tight range.
Yeah, for the front end, I can very clearly tell you that I think the bias is upward for yields because we're at the lows of recent ranges. And I think if you get that strong non-farm payrolls print, which in line with consensus, then it's a very clear direction, especially because the Fed, it's harder to see them wanting to cut sooner. Their bias is holding. For the longer end, that bias, I think, is slightly to the upside. But I don't know what breaks that range until we get some convincing evidence of where terminal is. In the U.S. So it's,
you think you stay in it, therefore?
I think, yeah, we're going to stay in that range as a result. The term premium argument obviously impacts more at your long end, but I think non-farm payrolls, you're looking more at the front end, and the bias certainly for yields is higher today at the front end, particularly because both those risk tariffs as well as non-farm payrolls coming in line and a strong report with the unemployment rate really being the kind of important bit that you're looking at, point to yields being
so that's a flattening of the curve, not a steepening of the curve then, that you're seeing. All right, Scarlett, thank you very much. Indeed, Markets Live, Scarlett Montgomery-Koenig on the market risks today. Let's get to some of the individual stocks that could be on the move at the open. Bring in Chloe Millet. Chloe.
Good morning, Tom. Let's start with the big story of the day, which is, of course, that Glencore and Rio Tinto are in talks to create the world's largest mining company with a combined value of more than $200 billion. So this is a potential deal that comes at a time of increased deal fever in an industry where companies just cannot get enough of copper. So we'll be watching out for the market reaction there. But at least from an investor's perspective, it looks like this is a deal that is quite doable with this portfolio manager, Tribeca, saying that it is the one big deliverable mining deal out there. So definitely a story to keep an eye on today. Moving on to the chip making sector, and we could have some positive read across from TSMC numbers in that sector. So TSMC revenue came in ahead of estimates, and that really reassured investors that there will be continued sustained AI spending in 2026 despite those fears around an AI bubble. And so we could see that positively reflected in those shares across that sector today, and in particular ASML and Siltronic, which are big suppliers to TSMC. And finally, we could also see some weakness in car makers today after Porsche and BMW were both cut to an underweight rating by Barclays. And so as we can see here, BMW has actually been outperforming this broader autos index, while Porsche has been underperforming it quite significantly. So we'll be keeping an eye on how that picture changes at the open and how much weakness we get in that car making sector this morning on the back of that Barclays downgrade.
Chloe, thank you very much. Chloe Melly with details of some of the stocks to watch. Also keep an eye on the grocery sector. Yesterday it was weak on the back of partially weak on the back of some of the negative numbers there. Sainsbury's with a slightly different take on things this morning, so we'll watch that. We're also focused on the weather around Europe, here in the UK, but also many other parts of Europe. Interestingly, gas prices going a little bit higher this morning, but European gas heading for a weekly drop because milder weather is thankfully returning.
Yes, looks quite cold in Berlin.
-7 apparently in Berlin right now. Yeah, Storm Goretti.
So, but that was definitely that hit Cornwall last night. It's hit the UK. It's coming through. It was snowing when I left the house this morning.
I don't know if Eurostar has restarted, but flights have been impacted. Trains to Paris have been impacted. I don't know if they still are, but there will be travel chaos as a result of this.
There could be. We will try and focus on things that are not chaos in the markets today. Although we have so many risk events coming up, it's hard to think that things might not get chaotic.
Such an exciting day.
It's interesting. A couple of people still putting the focus on payrolls. Valerie putting more of the focus on the Supreme Court. And really interesting questions about whether the Supreme Court's decision will make a lot of sense to everybody in the short term, whether it'll just open up more questions, not provide final answers, I suppose.
Well, I really hope so, because on Monday morning we're going to need something to talk about, so some confusion would be...
I suspect there'll be plenty there.
There'll be after-hours oil meeting as well, after European hours, the oil meeting.
20 leaders in a room with President Trump, who's going to be leaning on them, maybe physically, to try and get them to invest.
Yeah.
It's an amazing day coming up, and it's unsurprising as a result that maybe actually equity markets aren't doing much into the open here this morning, but there's the potential for significant volatility ahead. An exciting day coming up. This is Bloomberg. $7,000 still feels like a long way away, doesn't it? 69.21 is where we closed yesterday on the S&P. We kind of drifted sideways. Europe went out here, pretty similar levels to where we finished the session over in the United States. Everybody knows that today is going to be a really big day, and I suspect actually there's some caution in the market. Volatility is really low in so many asset classes at the moment. You can see it in what is going on with the rate space and the equity space. Yesterday, actually, commodities I thought were the most interesting trade. You saw some of the metals really being smacked around quite hard, but oil up, which is fascinating, Tom.
Yeah, commodities back in focus today for different reasons. You're seeing a little bit of price upside coming through for the likes of some of those precious metals. And to your point, oil is higher. So that could give energy as a sector a lift in the European space. Certainly futures are pricing in gains of 0.3%. Watch tech as well on the positive number coming through from TSMC and the read across to the likes of ASML and others linked to the TSMC and AI story. European futures then across the benchmark pointing higher by 0.3%. FTSE 100 futures here in the UK looking to add 19 points. DAX futures in Germany up 26 points, flagged higher by 0.1%.
Tom, let's talk about some of the stocks and sectors in focus, and tech is one of those. You've already mentioned it. TSMC putting tech very much in focus, those better than expected numbers, and saying positive things around the AI demand story and where we are in that. So that's a theme. We'll watch the mining sector, of course, because of the news around Rio Tinto going after Glencore. Will this actually get done? It's been 10 years that we've been talking about this, but we'll certainly focus in on that. Interesting dynamics around copper and Chinese demand to talk about as well. And Sainsbury's certainly in focus. After yesterday's disappointing numbers from that sector, today looks perhaps a little brighter. So we'll watch what happens to the Sainsbury's share price. Guy.
OK, our markets, our asset classes, a coiled spring waiting to bounce or maybe drop sharply. I don't know. We've been in ranges. It's going to be really interesting to see what the rate story looks like today. I don't think you're going to see much action in equities as we work our way towards the key risk events that are going to be there. London does have something to think about, though, which is what is happening in the mining space. What is happening with Rio and Glencore, I think, is going to be interesting. So it's interesting that London is kind of drifting a little sideways today. Are we going to go positive and negative? It's going to be interesting. I think we're going to be in and out of positive, negative territory. I'm waiting to see what happens with Glencore. The CAC's up a little bit. The IBEX is up a little bit. I'm not sure there's much to see here at an index level. Tom, what do you got at the sector level?
Yeah, unsurprisingly, as you were hitting on, Guy, energy is higher. It's top of the list across the sectors so far with gains of 1.4%. Tech is also getting a lift. And again, to Anna's point, not unsurprising given the numbers that came through from TSMC and the read across, and tech up 0.6%. On the downside, healthcare softer by 0.3%. It's a bit of a mixed picture across these sectors, Anna.
Yes, it is, and we haven't got the full mining sector story yet, do we? So Rio Tinto is open, and it's down by 2.2%. That's less than it was down in the Australia session, so maybe they'll take that as a win. And interesting that the market sees it that way, because I was reading some comments from analysts that weren't saying it was about the deal, because we frankly don't know enough about the details of any deal, and there is no deal yet. But it's more about what happens to other bits of the business and a lack of clarity around coal assets, for example. So a bit of nervousness there, so the stock goes lower, but only by 2%. On the other hand, Glencore's not yet open, and so we'll see what kind of upside we get, and that could really shift things around from a sector perspective, of course. Basic resources, not one of the best performing sectors right now, but we'll see what the opening of the Glencore share price will do to that.
What is interesting is Antofagasta's higher. So there is kind of, you are seeing some churn as a result of this story. So the copper story does go a little bit higher. So we'll wait and see what happens on that front. I am struggling to discern a clear kind of narrative that comes out of this morning. A little bit of volatility around some of the energy names. They're moving back higher a little bit. BP, Shell.
Because as you pointed out earlier on, over the week, oil prices are higher.
Yes.
So we had a drop actually on Monday on the Venezuelan news, anticipation of more supply perhaps into the US markets. But actually on the week, oil prices are higher, and it's, yes, Venezuela, very confusing, trying to get a handle on that. But there's also Iran, there's activity around Russia and Ukraine, and the market watching those developments very closely.
Well, let's bring in Max Kettner right now, then. Chief Multi-Asset Strategist at HSBC. Happy Friday, Max. How are you feeling? What is drawing your attention? What's going to move these markets today in terms of non-farm payrolls or Supreme Court? What are you focused on?
No, I just heard about clear narratives, and I thought, what am I doing here? But there we go.
Give us one.
Give us one. No, but look, I guess, what's the clear narrative? I think one of the clear narratives is still that actually earnings, near-term earnings expectations and near-term growth expectations, I think, continue to be a little too low, right? And that's particularly for the US. When you look at the US, for example, I mean, consensus saying 1% for Q4 and then barely a rebound in Q1. So even if you did say, hey, because of the shutdown, there will be some temporary setback in growth in Q4, but then the logical reaction should be, OK, Q1, therefore, will be the rebound. That's barely in the numbers. So I do think really for the next...
Earnings expectations get revised.
That's both for earnings and for GDP, right? For both, actually.
And then valuations look less concerning.
Yeah, and I do, and it's not just a tech story, because when you look outside of tech, actually, you look at the S&P, 8 of the 11 sectors now for the reporting season that's about to start, 8 of the 11 S&P sectors are expected to be down quarter over quarter. And I'm sort of thinking, sure, fine, there's been a government shutdown, but let's be honest, if you're one of the 500 largest companies in the US, do you care? Even if you're a consumer, let's be honest, if you were there in October and you said, oh, I'm going to buy a car, did you really a month later say, oh, my goodness, the government is shut down, I'm not going to buy a car now? Really? Like, why would you? And we see that in the hard data, no? We see that in credit card data. We see that in the Chicago Fed cards data. We see that in a lot of high-frequency hard consumption data, that there wasn't, particularly on the cyclical stuff, right, the cyclical big-ticket items, that there wasn't really much of an impact.
So the US economy doing pretty well then, by your analysis, Max, and the market not necessarily reflecting all of that. So what does that mean for payrolls today when we get that? Does that mean that the market should be looking for a stronger number and for an unemployment rate that does tick down?
Yeah, I think it could be ticking slightly down, because I think some of the high frequency and some of the proxies, right, from the Chicago Fed also point to a slight, slightly going down. The bigger picture, I think, here is that the level of rates, or the level of rate expectations, where it starts hitting risk assets, has clearly moved down over the last 12, 15 months. No, so to me, the worry that I have is we don't need 3-4 months of more hawkish CPI, more hawkish payrolls. I think one or maximum 2 months is enough. Because obviously, if you look at long end, the long end, and then very sort of big ultimate terminal rate expectations, which we always look at sort of the 3-year, 1 month, so short end expectations in 3 years' time, that's already at 340. And effective Fed funds is at 365. So effectively, right, you need one rate move priced out, one rate cut priced out, and you're starting to price in a tail risk of a hike.
Yes.
That is not great for anything, for spreads, for equities, for FX, nothing.
So do you think the Fed is done then? And how will... But we have a very busy White House right now, and the president's not afraid to interfere in markets, and we know he wants lower mortgage rates, and we know he wants a cheaper cost of borrowing, and we know he wants lower interest rates. What does that set us up for in 2026?
I think that story is a bit overplayed, to be honest. It's great to talk about, but then at the end of the day, I remember 2.5 months ago, there was lots and lots of concern about, but Fed decisions have always been unanimous, and what if it's not unanimous? Isn't that going to introduce all this volatility? And then we had 9-3 in December. I mean, we're all still... It's not like any of you just...
the Fed can withstand rebellion.
So what? Is that rebellion? I mean, would we call the Bank of England being like, oh, no, they had a split vote? If the Bank of England is 9-0, none of you sit here on the table it's like, oh, my God, that was contentious. No, fine, then it's 7-2, 6-3 or 5-4. It's the same thing with the Fed. Fine, then it's an 8-4 or a 9-3. Who cares?
OK. Front end of the bond market, is it mispriced?
Yeah.
In the US? Yeah. By how much?
I think up to 50 bips, to be honest.
Okay.
You look at the front end in the US, let's say December 2026, we're at almost 3%, 3.05.
Selling twos, yeah?
Yeah.
OK.
I think
selling tens?
Yeah. That's by extension, right? 30s is probably a different case because of supply and other kinds of things. The issue, I guess, with the very long end is that the Fed is already buying paper again. They're telling us, we're not doing QE. We just happen to buy 55 billion of paper a month, but it's not QE, which makes it really tough. And I get it because I feel very much in the space of every month when we write our allocation updates. Gosh, is this like another Control-C, Control-V update where I'm just like, I'm saying the same thing as in the last few months. Yeah, don't say that, I repeat it. Too late. No, but it's the issue then, of course, is if I want to say, but rates could be picking up, or what if payrolls are a bit high? Okay. Sure, maybe on the day there's a negative reaction, but if the Fed buys so much, you can't
reprice the front end by 50 basis points.
Then we're...
OK, what do equities do?
Then we're talking. No, if we really
you just told me that they're mispriced by 50 basis points.
Sure, but it depends on the path.
Okay.
No, it's not about where we end up in 12 months. In 12 months' time, or over the next 6-9 months, is the front end mispriced by 50 bips? Yeah, potentially. Okay. Is that really going to be something that's going to be repriced by 50 bips in 2 months? No, because that's the other good thing. We've got this K-shaped economy, so there isn't this clear picture where you can say, okay, payrolls today might be surprising.
But rates are going higher.
Yeah.
You started this conversation with Anna telling us that equity markets are going to do well because actually earnings estimates are too low. Which is more important, higher rates or earnings estimates for the equity path this year?
I think for this year, it's a bit like 2018. I think it's actually the rate side of things.
OK.
No? Because...
That sounds negative, equities, to me.
Yeah, of course. But it's is it one where you say, OK, we are definitely going to price in hikes at some point? No. I think it's probably much more sort of a ping-pong game where you say, oh, God, there could be a tail risk of hike priced in because we have 1 or 2 months of stronger payrolls or 1 or 2 months of higher CPI, and then the month after you realize, actually, no, there are still these cracks. Let's price it out again. So it's sort of this ping-pong. Choppy. Right?
It's choppy. Volatility, Max, because earnings will come through stronger, is your expectation, but rates will come up higher.
Yeah.
OK. So
which means valuation probably going overall a bit down, no? But that's not going to be the earnings side of things. It's going to be the driver now at the beginning because the earnings expectations are so low. But overall for this year, the other thing which I think is completely missed, which I don't understand in the 2026 outlook. So one of the things I really struggle with the 26 outlooks is people saying, AI is going to broaden and the Fed's going to cut rates once or twice more. So basically, wherever you invest, you're going to make money, whether it's rates, whether it's EM, whether it's carry, whether it's cyclical currencies, whether it's equities, whether it's tech or non-tech, doesn't matter. Just buy something, right, is basically the outlooks. The worry I have is, let's be honest, the big beautiful bill, right, the next 3-4 months, really positive. Because we get the tax rebates, right, in February and April. We get the consumption effect probably, so it's really good for consumption. Yeah. The CapEx incentives, really good for AI. The issue I see is, when we think from 26 to 27, we're forward-looking, right? We can't just always look at, the 8th of January, sorry. 9th of January.
Yes, I know, it's moving
See,
fast.
and I live in the past.
Yeah.
Damn it. But, you look at the 9th of January, it's like, this is what I care about. No, I think there is going to be a time around the summer where we think, hold on, isn't there a potential that actually monetary is done? We won't see any more rate cuts coming in 2027. There might be a risk of a rate hike. So we're moving from monetary tailwind to headwind in 27. Fiscal, the same. We get a negative fiscal impulse. and a negative capex impulse. That's the worry I have around, really, from an earnings perspective, also in the summer.
OK, and that ties in a little bit to the energy space and what we expect to see there, and there's been plenty of news flow around that, drifting higher oil prices. You've told us that you're underweight energy oil. Is that a conviction around, the surplus story just continues to play out and that's all that matters?
Yeah. Pretty much. It's very little to do with politics, to be honest, because the problem is on the political side, or let's say Venezuela and all I don't have any insight in that. And like you said, let's say if on Monday or on Sunday we would have known what had happened, would we have been short oil this week? Yeah. And we would have lost money.
Right.
No? So the political side is very hard to gauge. I think the surplus and the fundamental story on oil is probably much easier to gauge. So can we, go maybe tactically a little bit below 60 on Brent? Yeah. Okay. Is that the space where I would close it out? Yes, absolutely. I think we almost have no oil in our allocation. We're almost completely out, and we've been like that for almost 12 months. But I think once you get to the sort of 55 levels, it's tough to get even lower because, of course, shale doesn't make money at these levels.
I think we're done. That was quite a tour de force. Max Kettner, thank you very much indeed. Max Kettner, Chief Multi-Asset Strategist, joining us from HSBC. Let's take a look at what is happening with European equities. There's a few interesting moves out there this morning. Certainly the mining space is fascinating. There's a few big moves in the banking space as well, which are worth watching out for. But broadly across the board, we are bid, as you can see. Tech is actually leading us. ASML is up by over 2%, well over 2%. Schneider's rallying a little bit as well. But, yeah, it's a good day, pretty much for everything by the looks of things. Let's try and figure out whether that is really across these markets a good thing. Let's find out with Chloe Mellin.
Good morning, Al. We are seeing for the mining sector shares go into two different directions for Rio Tinto and Glencore after the two announced talks to create the world's largest mining company. And we are seeing Glencore shares reacting really positively to that, with shares up almost 8%. But then Rio Tinto is a little bit weaker this morning. This deal is all about gaining more access to copper, which is a metal that's been hitting new record highs and is really important for both the energy transition and also the AI boom. And it seems that Glencore investors are quite keen on this. Rio Tinto investors maybe a little bit less so. We'll be keeping an eye on that going forward. Moving on, but staying in the mining sector, and Antofagasta was raised at Goldman. And then also it is benefiting from the fact that the Trump administration is planning to overturn a mining ban in Minnesota. And so that would benefit one of the big projects that company has in that state. And therefore, we are seeing those shares move a bit higher this morning, up about 2% for Antofagasta. We're also seeing some positive movements for the chip sector. This is due to the positive read across from TSMC, with the numbers coming in ahead of estimates, which reassured investors about AI spending, given all those fears around this AI bubble. And therefore, we are seeing ASML in particular, which is a key supplier to TSMC, move higher almost 3% this morning. Moving on to L'Oreal, we also have a green there as well. It was upgraded to a buy by UBS analysts, and therefore we are up 3.6%. And finally, the only stock that we're talking about today that is in the red is Sainsbury's, because it reported weaker than expected sales. This is following the similar numbers that we had from Tesco yesterday, and shows that maybe shoppers in the UK wanted to get cheaper groceries for their Christmas shopping and went to Aldi and Lidl a little bit more than they went to Sainsbury's and Tesco, and therefore we are seeing some weak Christmas trading for those companies, for those supermarkets, and we are down 4.3% for Sainsbury's this morning.
OK, Chloe Mellin on some of the stocks on the move today. Chloe, thank you. Coming up, and Chloe was talking about the mining stocks, of course, Glencore soaring and Rio slipping, as the two are in talks to form the world's biggest miner. Those conversations are back. We're going to take a look at the likelihood of a deal and what it all means for the broader industry. That's next. This is Bloomberg.
17 minutes past the hour, 18 minutes past the hour. This is what equity markets look like. A little positive. Could be worse. There you go. Up again. There's some interesting stories, obviously, in London today. There's actually some interesting upgrade stories which are affecting the market as well. Look at what is happening. Some of the French banks definitely on the move. As a result, some upgrades, downgrades. So just keep an eye on kind of what broker notes are doing as well to the market this morning. But the really interesting corporate story this morning is what is happening in the mining space. And London listed shares firmly in focus. Reports that Rio is once again in talks to buy Glencore, create the world's biggest mining company. The new entity would have a combined market value of over $200 billion. The news, of course, today comes a little over after a year after the last set of talks collapsed. So are these ones going to be any more successful? Is there anything changed here, significantly changed here? Is it going to be harder, maybe, to get a deal done? Bloomberg's Mark Burton, who leads our EMEA mining and metals coverage, joins us around the table. We've been here before. Why is this time different? Could it be different? Are the challenges greater or less?
We have been here before. We've been here twice. 2014, there was a move by Glencore to put itself in play, discussed that deal. That ended quickly and acrimoniously with both of the companies kind of engaging in a bit of a shouting match. That underscored the gulf between the two cultures of the company. 2024, they I think had more kind of robust and comprehensive discussions about how a deal might get done. And I think the stumbling block there, among other things, was principally around valuations. Copper deals are a great thing to do, but they're also incredibly difficult to get done because the industry is universally bullish on copper, and it means that whenever these two kind of companies come together, the bidder doesn't want to overpay, and the target doesn't want to be accused of leaving money on the table in an environment where everyone is kind of picking their targets for where copper prices might go.
Absolutely. And that's very much a talking point at the moment, isn't it? More on that perhaps in a moment. But what about the fact that we've got a new CEO at Rio Tinto? What does this tell us?
So I think they both had investor days in December. Glencore was setting out its stall as a copper company, has a huge amount of growth after periods of kind of slumping output in its copper business. It was basically saying, look, this is our focus. This is what we offer you. People have kind of interpreted that as a process of it opening itself up for a company like Rio to come and take over. Rio, meanwhile, under its new CEO, presented a much more kind of internally focused proposition where it was going to be developing its own assets. It's just brought this massive new iron ore mine into production. It was a much more kind of conservative pitch to investors. Now we have a different proposition, potentially creating. Yes, exactly. So, but then behind the scenes there were, I think there's an effort to simplify the business in a similar way to focus on copper, and I think there's for both kind of Rio and its rival BHP, there's a kind of period of softer growth in copper ahead, and I think among their investors there's perhaps a greater mandate to go out and do these types of deals to quickly bring on copper at a time when prices are roofing it.
OK. Thanks very much, Mark. Plenty to talk about this morning. Mark Burton from Bloomberg with the latest on M&A in the mining sector. Plenty of risk events on the agenda for today as traders look ahead to US payrolls, the US Supreme Court opinion day, possibly, on tariffs. Let's bring in Bloomberg's Valerie Teitel to set us up for all of that. You were more excited earlier on about the Supreme Court. We had a couple of guests who put
very controversial.
Oh, is it? We had a couple of guests who put focused on non-farm payrolls. You think the drama in the Supreme Court, then, Valerie?
Well, I think. Okay. There we go. I've got someone on my side. But no, I think that there is going to be lasting, historical ramifications from this decision today, in terms of the limits of presidential power. And I tie that into the news of the day that Trump obviously cares about the mortgage market. He wants to buy these mortgage bonds. He's talked about declaring the housing market an emergency. He would do that by using IEPA, and IEPA is what is on the bench for this Supreme Court decision today. Has Trump overstepped his use of this Emergency Powers Act in order to enact these tariffs? So I'm interested in it from that big point of view. I'm also interested in it because, if these tariffs are smacked down, what does all these other countries do who have signed these trade deal commitments with the U.S.? If Trump does enact Section 122, which is essentially another placeholder that he can enact if these IEEPA tariffs are struck down. That is a blanket 15% tariffs on everybody. So those who are maybe negotiated a lower one, what do they do? Those who negotiated, and this is maybe a deal for them, how do they react? So I think it does start to pose some bigger questions on more volatility, at least when it comes to the tariff situation, the trade deal situation with the Trump administration.
When it comes to jobs, and I know that's less of a focus for you than the tariff story, but in jobs, is it the headline number, is it wages, or is it the unemployment number?
Look, I'm looking at the unemployment rate, and I say that for a few reasons. The headline number has been very volatile of late, has had a lot of revisions. I know we've all talked about the lack of quality in the data. So look at the household survey when it comes to the unemployment rate, because I think that what the market is vulnerable to is a massive narrative shift. If the narrative all of a sudden shifts to the fact that maybe the labor market isn't weakening, maybe it's healed from the weakening track it was on last year, perhaps it's starting to tighten again amidst all of this economic positivity, the AI trade maybe becoming more of a positive for the labor market, that could cause some big changes to how we're viewing the Fed this year. I mean, that could really put hikes on the table for the Fed, and I think that's what the market is vulnerable for. If we see the labor market healing, the unemployment rate drop down to the 4.3 kind of territory, I mean, there would be an argument to be looking at hikes.
Max Kentner thinks 50 basis points mispriced at the front end.
In which direction?
Up.
Up, yeah.
Does he think, how much of a cold spring is the market? You get out of the recent ranges, how quickly is this all...
The data on the labor market has been very cloudy of late. It's been very hard to tell whether we're still weakening or not. And once we get that kind of clarity, if it's in the direction of the labor market strengthening, you have, these bullish GDP figures already from the Fed for this year. Add into that what the Trump administration is planning on spending, this fiscal boost. There could be real arguments that the U.S. economy is about to take off.
Valerie, stay with us. What are you up to for the weekend? We have time to talk about...
We don't ask Valerie that question.
Our weekend. We have time to talk about our weekend, which for some people will feature skiing and plenty of sport. Probably not for Valerie. I would advise against. But watching the Golden Globes, that seems like a safe activity.
Yeah.
You'd have to stay up late for that, don't you?
You do. That's on a Sunday, actually. Yeah, so I won't overcommit to watching the Golden Globes.
Monday morning, that's what we're going to be talking about.
Yeah. I see Guy as an alpine skier. Salopettes?
Yeah, just come back. Where are we this weekend? I can't remember where we are this weekend. Anyway, yeah, the downhill's going to be on. That's
you
going to be
didn't break anything skiing.
I nearly did.
Headline.
But anyway, that was kind of neither here nor there. But yeah, loads of sport this weekend. Fantastic sport this weekend.
It's the quarterfinals of the Africa Cup of Nations. So Mali, Senegal today. Cameroon and Morocco today as well. 4 p.m. and then 7 p.m.
He's been doing research.
Quarterfinals.
My research is just focused entirely on the Golden Globes, so I have nothing to add on that front.
So you're going to be the fashion correspondent on Monday morning.
Absolutely. I know, I'm all about the front runners for the Oscars. It's very competitive this year. Tom's been watching the tech story, though, as ever.
Talking of entertainment.
So we're done. So we're saying our weekend starts now.
Say goodbye
our weekend starts now. This is fantastic.
You can go off and enjoy your weekends. That's it for the opening.
Val's away for a few months, in fact. She's got somewhere to go.
Yes, maybe the hospital, but only for good reasons.
Yeah, absolutely.
The tech show is next.
The tech show is next. Entertainment, music, AI, Will.i.am, exclusive interview. That's coming up. Bloomberg Tech Europe takes a deep dive into how AI is shaping the music industry, what it promises, some of the consequences for the makers of music, of course. That's all coming up. Exclusive conversations. This is Bloomberg.